Let's get into this story. I'm not going to ask you about the political gyrations and what's going to happen with the vote and who should be and who shouldn't be the president. I just want to understand your understanding of the situation and what it might mean for crude supply in the months to come.
Well, so there's two elements to the Venezuela story. First, will the protests end up leading to potential disruptions, which clearly the market doesn't seem too worried about. As Lisa just pointed out, commodities are going down because it's a demand story, or a lack thereof, rather. In the case of Venezuela, I mean, I think potentially it could be a bullish factor if we get some disruptions on the supply side, but also a long-term experience. If there is a change of government in Venezuela, remember the opposition has run a campaign on three pillars. First, they want to reunite families. There's almost 8 million Venezuelans that have moved abroad. There's also an element of eliminating all of the price distortions that they've introduced in the economy. But very importantly, they want to privatize the oil and gas sector. So I think if we go down that route, because there's a change of government, and maybe we are getting a little too ahead of ourselves here, but if there was that change of government, you could have the unlocking of what's effectively the world's largest energy reserves. Let's not forget, Venezuela has non-conventional, but the world's largest. And again, we have so much more technology today that if that were to be the case, I mean, you could have an enormous growth in the country should that get to a point. But again, I'm not saying it's going to happen.
Granted,
we're very far.
I get all of that. This is a highly speculative conversation, and this is certainly not revealing any of your base cases or any of your calls. But I do think the scenario analysis is worth it. What is online right now from Venezuela in terms of crude, and what could be online if you do start to privatize and the world reopens?
Right. So Venezuela produced more than 3 million barrels a day of oil back in the day I'm going back pre-Chavez, right? So it's been on a slippery slope ever since the big strike that we had in Venezuela in PDVSA in 2002. In fact, the bull run in commodity markets that we saw in the 2000s kind of really kicked off with the PDVSA strike in 2002, which was basically the workers of the National Oil Company facing off against, back then, Hugo Chavez. And since then, Venezuelan production of oil has been rolling down, and particularly the last 10 years or so has really collapsed to levels, to a low of 500,000 barrels a day. And since then, we've recovered to give or take 750,000, 800,000 barrels a day. So it's a fraction of what it was, and back then it wasn't what it could be. So again, it's the world's largest oil reserves. Think Saudi Arabia, think Canada, think Russia, if you were to get that opening, right?
So given that this is speculative, right, this isn't what's driving prices lower. No. We were talking earlier that this is essentially a story of demand. Right. This is a story of China and a lack of demand there. How much is it broader than just a lack of demand from China?
It is broader. I mean, you guys were talking a little bit about it before with Germany. If you look at the industrial economy globally, it's doing pretty badly. We've been waiting for lower interest rates and China stimulus to get the commodity complex back on track, and none of this seemed to be coming together. You mentioned it yourself. I mean, the Communist Party leaders spent a week locked up trying to figure out what to do about the economy, and they came up with a 10 basis point cut to mortgages, which seems like, okay, maybe you need a little more than that at this point. But here's my take. I think they're all waiting for the U.S. election to play out because I think we're just 3 months away, and things could really change for China. So why use your dry powder? Why use your dry powder 3 months ahead, relative to when you may really need it, right? So I think one of the most challenging things for China is that not only they have an issue about how to recycle their savings, which is very visible in some other commodities like gold, right? But also China has an issue of creating creating domestic demand, and of course it has the issue of tariffs, right? Potential tariffs from the U.S., potentially from the Europeans, although that's as you pointed out, it's a bit of a different story there. But that's not really helping China. I mean, China's been historically a large exporting nation, and now it's getting hurt on the back of that.
But take a step back. Is this entirely a China story, or is this something bigger, especially at a time when we're all talking about infrastructure building in the entire developed world, and at the same time, copper prices have fallen down significantly. We've seen oil prices fall pretty consistently, even with the potential supply disruptions in the Middle East if things do become more kinetic. There is a real question here about whether we are overestimating or underestimating the slowdown in demand to build, to keep traveling.
Look, 100%. There's an issue here, is that rates are still very, very high. We don't realize, I guess, because we've kind of gotten used to like rates being 525, 550, but rates are very high. I mean, they're really, really high, and you know, they're high because the U.S. demand story remains very strong. But the higher the U.S. rates remain, the worse it's going to be for the rest of the world. And I think China also faces higher U.S. rates, and the rest of the world faces high U.S. rates. And as I mentioned, you have this combination of high U.S. rates, which are driven mostly by the services sector, right? They're not really driven by the manufacturing sector. Manufacturers would love to have lower rates, right, in this country, and the rest of the world's kind of struggling on that too. So to me, it reminds me a little bit of what was going on back in the 90s, where you just had high U.S. rates and a very strong dollar, and that wasn't helpful for emerging markets. And I think that's the policy mix that, frankly, will likely continue post-November in one way or another. But unless we start to get lower rates, I think emerging markets are really going to start struggling here.
We've mentioned a bunch of commodities that aren't doing so well. Yeah. You mentioned one that is. You said gold.
Right.
Gold's near all-time highs. What's behind this move, and how many clients are asking you about it at the moment?
So, believe it or not, gold is not as widely owned as you would expect, right? So, there's a couple different elements to the gold story. There's obviously central banks, which are all buying gold in droves because they don't trust each other. The freezing of central bank assets of Russia, right, really triggered an enormous expansion in central bank gold holdings. I mean, if you look back the last 30 years, two inflection points. 2008, global financial crisis, we went from seeing central banks selling gold to net buying, and then more recently, 2022, freezing of central bank assets of Russia, suddenly a big jump in central bank holdings because of that action, which, you know, a lot of people question the legality of it. So that's one big story. Second big story is really what's going on at the retail level. Europeans are selling gold. U.S. has been selling gold, you know, if you look at ETF holdings. But the Chinese have been buying gold. And we go back to the problem of China. They cannot recycle their savings into anything productive because they went into housing, and the housing market went bust. They went into tech, and the stock market went bust. They went into factories, and then we started throwing tariffs at China. So I guess people are like, well, will I put my money in? Well, I guess the Chinese central bank is putting money in gold. Maybe I should too. And so the central bank started to slow down their gold purchases, right, which is interesting. So I think gold, like I said, is really a story around China retail buying and central bank buying. And it just goes to show how frail the global economy is and how much fracturing we have in the global geopolitical system today.
When you say don't trust each other, do you mean don't trust the United States? Is that an important distinction?
I don't think
because I'm thinking of that diversification away from the US dollar.
Right.
Is that the important piece of this?
Well, we always hear that, but the reality of the matter is the most pounding when you look at global currency reserves in the last few years has been the euro. Because remember, the biggest buyer of euros was actually Russia, right? Because Russia sold its energy to Europe in euros, right? For the most part. So the dollar has been kind of just fine. It's been the euro, but I think generally you could say G10. You could say Western world's been facing those challenges as the world's kind of fractured geopolitically. And I think pretty much every country that is not 100% aligned with the U.S. and Europe has been veering off towards buying more gold, and that basically means every country, right? Even we've seen NATO allies like Turkey buying gold. We've seen allies of the U.S. and the U.K., Singapore buying gold. So if you look at the data, there's really broad spread gold buying.